I know, it's a bold statement to make, but the numbers don't lie. Take this one step and double your returns. While I definitely focus on dividend investments and cash flow on this channel, I do cover a wide array of different types of investing topics. Two key principles I've mentioned multiple times on the channel are, number one, we don't have to invest only in dividend-paying stocks to be successful, right? You can invest in index funds, ETFs. The biggest thing you need to do is actually invest, and invest consistently. The second big component I've talked about time and time again on the channel is don't try to time the markets. I get tons of comments on my videos saying, well, should we invest right now? Is now a good time to invest? I don't know. I have no idea what the market's going to do in the future. I can only tell you what the market has done in the past. And as a result, I often will tell people, depending on your stage of the investing journey, the best thing you can do, what I do myself, is I invest every single month. Because I can't tell you if we're at a new high or if we're at a new low, or if we're going to be lower the next day or lower in a month. That being said, above and beyond just investing every single month, we can also be a little bit more intentional with how we put new money into the market. In this video, I want to show with you in my own spreadsheets exactly what's possible based on actual historical data, facts, data, the real thing, what is possible if we, yes, stay consistent with fixed investments every single month, but above and beyond that, if we can be intentional and strategic about when we put additional new money into the market. All right, so we're looking at one of my spreadsheets here, and again, all of my spreadsheets are available in the Patreon community, where you have access to, like I said, all my spreadsheets, you have access to all the moves I make in my own portfolio, and you have access to a private Discord community to talk to like-minded average Joe investors. If you're interested in that, check out the link in the description below. In this spreadsheet, we are taking a look at investing every single month, dollar cost averaging into the S&P 500, the ETF SPY. Now, I'm making some assumptions here. I'm going to assume, we're going to look at two different scenarios, actually a few. We're going to look at a lump sum investment where we start with $25,000 and make monthly contributions. And we'll also look at a scenario where we start with $0 in the account and we contribute $400 a month. Now, additionally, what we're going to look to do is above and beyond our fixed investment here, $400 a month, we're going to look to make dynamic investments into the portfolio based on what the market is doing. You've got this tab right here, which is the variance tab. So, in general, all things being equal, it's better to invest when the market is in the red, right? When it's losing money. So what would it look like if we made our fixed investment every single month of $400, but above and beyond that, if the market were to reach a certain threshold, if it's down a certain percentage, if we were to invest additional money. So this assumption here, we're going to look at an assumption where we make our $400 a month investment, but we're also going to add a dynamic investment into the portfolio if and when the market is down 1% or more. If it's up in any way, shape, or form, we don't add additional money. If it's down 1% on the day, we add a specific amount of money, and we'll look at a few different variances here. So first off here, we're going to assume that we're going to add $100 to the portfolio on any day when the market is down 1% or more. Okay, we're not timing the market here. I want to stress that enough. We are not timing the market. We are making fixed contributions every single month, no matter what. But what we're saying is that above and beyond that, we are making strategic investments, additional money into the account if and when the market is down on the day at least 1%. We are looking at the actual prices and the actual dividends paid out by the S&P 500 since July 9th of 2012 all the way through July 8th of 2022, 10 full years. This is actual data. The variables we are changing is how much money we invested along the way. So if we first off assume that we started with $0, we reinvested all dividends, as of today we would have $87,702.98. But if above and beyond that we decided to invest an additional $100 every time the market was down 1% or more, we would have $127,643.26, which means that over those 10 years, we added an additional $100 254 times. This would result in an additional 46% return on our investment. Now, if we happened to start with an initial $25,000 in the account and then we tried the same strategy, we would have $178,000 with no additional dynamic investments versus $218,000 if we had made dynamic investments. This would be an increase of 22% above and beyond our normal way of investing. Now let's say we wanted to change this. Let's say we had we could make an additional investment of $200 every time this happened. If we did this, okay, starting with $0, after 10 years, again, we would have $87,702.98, like I mentioned before. But now, if we made dynamic investments, we would have $167,583.54, which would be nearly a 200% return, 191%. We're essentially almost doubling our money in this scenario. So let's say instead here we're going to modify this. Every time the market is down at least 2% on the day, we're going to add, remember, 2%. So if it's down 1.5%, we're not going to do anything. But if it's down at least 2% on the day, we're going to make a one-time investment every time that occurs of $400. I'm not saying everyone can do this, right? But if we have the ability to just save up our extra money above and beyond and just say we're only going to invest this new money every time the market is down 2% or more, let's see how that strategy would work out. Assuming this is above and beyond our normal investment, again, because we're dollar cost averaging, of $400 every single month. So check it out. I love flying. Every time I get on a plane, I have to sit in the window seat. Honestly, if I could roll the window down in the plane, I'd do it. I'd hang my tongue out the window because I love flying on planes. But I have to be honest with you guys, despite that excitement I felt, many times in the past, I've had a significant level of anxiety because despite how safe planes are, it's very possible it could be the last time I ever see my family. One thing that has definitely helped to reduce anxiety for me is making sure that I had life insurance in place. That's why I'm excited to be partnering with Fabric. Fabric has made life insurance easy. It's built for parents to manage their family's financial future stress-free. Prices are affordable, accessible, and highly competitive. And when I say affordable and competitive, I mean like $1 million of coverage for less than $1 a day. You can apply online at meetfabric.com in less than 10 minutes. Coverage could be offered instantly with no health exam required. You can view your quote and customize your policy to fit your family's needs. There's no risk to apply, and Fabric has a 30-day money-back guarantee, and you can cancel at any time. So do me a favor. Do not get on another plane without applying for life insurance. Once you have your life insurance in place, you can also set up a will, start a college fund, or even a savings account. Make sure to visit and apply today because your family, yes, your family is worth it. Make sure to visit meetfabric.com/Joe and apply for life insurance today. Even if you already have a life insurance policy in place, visit meetfabric.com/Joe and apply today. All right, so we would have, again, our normal scenario where we're not doing any dynamic investments, where we have a total of $87,702.98. Under this new strategy, we would have $136,421. This is an increase of 56% above and beyond our normal strategy, which is less than the strategy of adding $200 a month every time it's down 1%, which is fascinating because this actually resulted in more money, I believe, almost more money going into the account, but a lower return, which tells us that it's better for us, based on what we showed here, to invest less amount of money, right? $200 or $300 or $400 a month into the account, but doing it whenever the market's down at least 1% versus waiting until it's down bigger at 2%. Just based on historical data, we have no idea what the future is going to hold. Here's that data charted out here. Fixed monthly investments versus fixed monthly plus dynamic contributions. This is here if we're starting from $0 and we're assuming $200 dynamic investments every time the market is down at least 1%. This is, you can see how, from the beginning here, we stay about the same, but we start to make additional investments here right out of the gate in 2013 and 2014. We are adding new money here, and we are breaking away with this dynamic investments here to the point where when we get to COVID, we really start to have a lot more shares, which means we start to outperform even more from 2020 all the way through 2022. Here's the same chart, but this is based on an additional $25,000 lump sum investment. The results are not quite as significant here because we started with a $25,000 balance in both, but the situation is the same here. With this and the dynamic additional contributions based on when the market is down, we have outperformance here with that strategy. Again, don't time the market. Guys, I still am a huge advocate for you guys investing every single month. If we're in the contribution phase of our investing journey, we're adding new money here. I'm a strong believer in our core strategy being to add money every single month to our retirement accounts first. And once we are on our way there, then above and beyond that, we can add additional dynamic investments to our retirement. Or what we can do is start to make investments in our brokerage account if we have desires to potentially retire early or have other investing objectives to accomplish. Dynamic investments into your account might be a great strategy for you guys to take advantage when the market is down. Make sure to leave your 2 cents down in the comments below, guys. I value all the feedback I get from you guys, and some of the comments I get are great suggestions that end up leading to new topics and new videos. So make sure to leave your 2 cents down in the comments below. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.